Savings versus investment. You go for a job to earn money. This money that you earn is called income. Money is required to buy food, cloth, and to pay your bills. When you have spare money or that extra amount left over after your expenses, that becomes your savings. This would mean you've saved some money after meeting your expenses. Therefore, savings is money available after spending. Let's take an example. John earns rupees 8,000 per month. He spends rupees 2,500 on food, rupees 500 on cloth, and another 500 to pay his bills. He has to pay a rental amount of rupees 1,500 every month to his house owner. John recharges his phone once in a month for rupees 500 as well. Here is a small calculation for your better understanding. John's income is 8,000 per month. His expenses would amount to rupees 5,500. And therefore his savings would be income minus expenses, that is 2,500. John has a good friend Ram who works at a bank. Ram is also a learned financial advisor. John learns from Ram that little by little, the savings he has every month could be invested in installments, which would mean month on month, or as a lump sum, that's one time, to generate more money. If John opts to keep his savings with himself, the money he has will not earn him any returns. Depositing saved amount or savings in financial instruments or assets with the hope of generating returns in future is called investment. Therefore, investment is money earned from savings deposited or invested in assets like recurring deposit, fixed deposit, property or real estate, bonds, debentures, stocks, mutual funds, treasury bills, etc. Let's return to the previous example where we had John saving rupees 2,500 every month after meeting his expenses. With no other unforeseen expenses coming up, John would end up saving rupees 30,000 per year. John's monthly savings is rupees 2,500 and his projected annual savings at rupees 2,500 multiplied by 12 months will give you rupees 30,000. John has the following investment options. Recurring deposit, deposit rupees 1,000 every month for 12 months and earn 5% interest, or buy stocks by investing rupees 1,000 every month, or buy government bonds of rupees 2,500 with a guaranteed return on principal, and it carries an interest of 3.5%. He is also left with an option where he could wait for the end of a year where he would have saved rupees 30,000 by then and invest that whole amount in stocks of deposits, recurring deposits or fixed deposits, in government bonds, or a combination of any of these. There are more options available, but for the sake of this example, let's just keep the options minimal. John has the option of investing every month or annually, and he would decide on his risk exposure from high to medium to low. Risk is higher for stocks, but the returns could also be much higher. Low risk investments are recurring deposits and government securities. To have a quick recap, savings is money available after spending, whereas investment would mean buying assets such as stocks, government bonds, treasury bills, recurring deposits, debentures, mutual funds, etc., with a sheer expectation that your savings will grow over time. That's all about savings and investments.